Okay, go live. And okay, so I don't know why this is not connected to your Twitter.
It
It is
says I need a premium subscription on Twitter. I'll upgrade in a sec. It's like it doesn't take.
an
It's
error
not
with
having
your
access.
guest destination. We inform so they can fix it. Okay, I don't know what to do, but that's totally fine without it too. Or what? Like you want to fix it too? Or I think we're already
Yeah,
live.
yeah. I'll fix it. Very quickly upgrade to
Okay,
premium.
go for it. Yeah, yeah, yeah.
It's
I
it's
have a
pretty much done.
premium. I got so I got locked out of my own Twitter this week, so I'm posting from third party platforms.
Wow.
Um, I yeah, it's um. Anyway, long story. I did not do anything wrong. Someone tried to log in as me, but it was a lot of stuff.
So I don't know it doesn't work because I paid. I'm already premium,
Yeah,
but
I'm already yeah.
it takes
It,
time for it, I guess.
oh
Yeah.
God, I'm sorry about that
No
too.
worries. No worries. Uh, okay, let's go. Let's go. Maybe without Twitter, it's fine.
Okay, thank you. Yeah, I feel like
I wish
it's a journey.
okay.
Uh, well, we can always repost after this, so it's immediately on YouTube. Okay, so to start the show, I would love for the audience to get to know you a little bit more. And okay, so I think some of the most interesting things about you is like you're from another country. Now you're investing in immigrant. You were originally working in engineering, and now you're investor. So like maybe what are some like core lessons that you've learned at your Google Meta era that you kind of took to investing nowadays?
So the core lessons. That's first of all, thank you, Grace, for inviting me. Really great to be here, and you know, looking forward to this discussion. So the core lessons, of course, the things that when I joined Google. Before that, I worked in a very small company back in Belarus. It was a jump into a company that was a really big successful company at that point already. I joined back in 2007, but also the company that was a success result of a venture ecosystem, right? So as we know, Google had angel invest and seed round and went all the way to IPO in about 5 years. And by the time I joined, it was about 2,000 people company. So the things were like, first of all, how to build products for really large audience for the
Mhm.
whole world, and how to operate in a sense of like, what does it mean even to build a product? What does it mean to build a significant technology and a system that would withstand time and requirements to support a lot of users, right? So a few things that are obviously things like leadership, things like product management, product building, things like architecture and systems, and of course, machine learning, which
Mhm.
I started to do in Google and then continued in Facebook.
Mhm.
And uh, when I was inside and I saw some people leaving to start their own startups, some people starting investing as angels. And then when I was attending conferences and meeting with startups, of course, I was learning a lot about the world of venture, the world of investing. And it was always for me, it's like, okay, I'm experiencing company like Google from inside, but how I can help building a company like Google from the very beginning.
Mm, I love that. So I wonder, who is on your personal board of advisors when it comes to actually starting your own fund? Because I feel like from an engineer to building a fund, there's like so much going on, and I wonder how do you kind of like um, find mentorship in the industry to actually like build out your own practice.
Yeah, that's a great question. So one thing that is there is a huge difference between investing your own money and actually starting a fund,
Mhm.
right? So it's hard to start being an angel investor, but in a way you can just do it by finding one company,
Mhm.
signing a agreement, and
Mhm.
wiring the money, and you're a private investor. To
Mhm.
start a fund, of course, is much more significant. Venture. So you basically need to figure out the thesis, convince people to give you money under management, build the whole legal structure, and basically plan
Mhm.
this thing for a long time in the future, and make sure that you are doing all the best to not lose other people's money, right? So and um, there is much more to building a venture firm than just investing. I was lucky back in 2021 when I had an idea of building a venture firm after 10 years of angel investing
Mhm.
to come across VC Lab. So, and VC Lab is a first of its kind accelerator for venture firms. So, it's basically helps people who have some investing background to build a firm. And I went through a program back in 2021, and they helped me basically to figure out what to do right and what mistakes to avoid in order to build venture firm. Of course, I met quite a few VCs over time that have built firms before me, right? So,
Mhm.
and some of them even invested in my fund. Like, so for example, GPs of Fly Ventures in Germany or Flyer One in Portugal, they both invested in my fund and they gave me some advice on and shared experience from their previous experience of building the firm a couple of years before me, right?
Mhm.
So, and since then, I met with many more VCs, right? So that have built firms over time.
I wonder. Okay, so I want to dig deeper into the fund building thing. So, by the way, I want to say hi to Sarah. You're from your team. She
Yeah.
deserves a raise. Love that. Okay, so I want to learn more about when you were thinking about. I think like back in time when I'm sure like I guess like one question I feel like a lot of the audience have been asking was how are you like how long does it to take from talking to LP and then like what is a journey like after let's say you have an initial conversation with the LP and how do you think about the rest of the process like how many meetings so some people say some bigger LP it only took them like 2 meetings but some smaller LP it may take them 10 meetings what are the second meeting to the end of the meeting kind of look like how does each step kind of progress after you did your demo for your fund not
So,
your in particular but obviously the general concept.
so raising for a firm is for a venture fund is definitely a different beast than raising for a company. And the
Mhm,
main thing is that because LPs are so different,
mhm,
especially so. First of all, there are big classes of LPs. There are individual LPs who are not professionals, who are just investing
mhm,
their own money, and
mhm,
they take it as like we need to figure out how to invest the money. And for money of those LPs, you compete with things like real estate, right, or
mhm,
stocks, not just other venture funds. And there are, of course, professional Ps. Professional Ps who know that we need to invest in 10, 20 venture funds. These are either fund of funds or like pension
mhm,
funds or endowments and so on. So, and individual Ps are so vastly different, right? Because each of
mhm,
them has their own situation.
mhm,
Somebody just got a new family member. Somebody
mhm,
is buying a house, right? Somebody just got an exit because they were like a pre-IPO company, and it all changes the environment. But therefore, each meeting and each LP journey is different. Like, for example, I think one very interesting story is just yesterday, I finally closed an LP who initially reached out to me with a cold email almost a year ago, right? It was like probably 9 to 10 months ago. And that was the first time I think I closed an LP that reached out to me with a cold email.
mhm,
And uh, it took probably about 7 meetings over that
mhm,
time, and you know, it's a very very interesting journey, I would say, because for each LP they need different things, and very often it's a combination of them learning about me and my fund, right? So, and then and the combination on is it the right time for them, right?
mhm,
So, and when I started in 2021, one thing that the environment helped me for the first few months. So because I ended up being able from the initializing my race to doing the first close, it was only 2 months, and in that time almost all LPs that ended up joined me after one or two calls, right? So it was
mhm,
like, yeah, it was the right time. People had liquidity. People were open to opportunities. And with my story and the track record and the strategy, They're like, okay, it makes sense, let's sign. Of course, the years 2022, 2023, especially in 2024, were much harder to raise, right? So a lot
Mhm.
of people were like, okay, we like your strategy, we like your track record, but we have low liquidity and we need to figure out. So the bar for LPs or potential LPs to invest became
Mhm.
higher. So it's not just enough to have a track record. It's important for them to really see that, are you going to be able to repeat the good results even in the bad years. And then there was this time over 23, 24 when stock market actually went from the bottom point fairly quickly up. And they're like, okay, are you able to compete on the returns with the stock market, right? So a lot of
Mhm.
things like that. Of course, um, the lack of IPOs, also limited number of per individual piece, because typically every time after an IPO, 6 months later, a lot of people walk out with millions, and they're looking for funds to invest in. But because there were very few IPOs, it made it difficult. So yeah, to round up, I had a lot of investors coming in after just one call, but there were quite a few
Mhm.
that needed 5 to 10 calls or meetings in person. Yeah.
I wonder, would you say you go after the bigger anchor LP first, or do you go after just whoever you're like closer with? And do you really feel like the warmer relationship is better to turn into investment?
So this,
Or
yeah, two very different questions. First of all, I personally don't have a lot of experience with NKLPs. I never had one, and I was never looking for one. I
Mhm.
personally think that, it's thinking of anchor LPs is a bit of putting all eggs in one basket. So,
Mhm.
and I know some other GPs of other funds that are, because they went after one anchor
Mhm.
LPs, they take a year or 2 years to close the anchor LP, and they need to wait. And then sometimes the anchor LP says, "Oh, we'll sign like next week," and then the next week turns into a year from now because something happened, right?
Right, right.
Something got fired, some strategy change, and so on. I rather prefer my eggs in many baskets. So I don't like to have anchor LP. I like to have a lot of LPs who are all deciding for themselves. They all know there's no anchor LP, but they know they're participating in a fund when there are a lot of other people, right? So, and yeah, I think that approach works well for me. And in terms of warmer, of course, this is, I think, what I found, especially for new GPs, for the first fund. The biggest thing you can do is to talk to people who know you, right? And this is what
Mhm.
advice I give all people who are raising for their first fund. Um, be very careful about wasting your time on trying to go to like LP conferences and meeting a lot of new people, because these people will take years to get to know you
Close. Okay.
and to close. But if you know somebody for 3, 5, 10 years, even if they are not a professional P, it's often better to talk with them about your fund and educating them on VC if they're not knowledgeable, right? And close based on the relationship, especially when your track record is not from your firm, right? Because your firm just started existence recently.
Mhm. I wonder, so how do you manage the LP expectations? Just because I feel like the individual LPs that you're solicit from, it's like harder to maintain their like the relationship if let's say you're very close with them, but like some people are new to venture, so they don't really hi Volo Demir. Okay, so I'm sorry, I cannot like I'm trying to say hi
Vladimir,
Vladimir.
yeah, it's very
Okay,
typical Ukrainian name. Yeah,
yeah,
but yeah, same
yeah.
as Zelensky. Yeah.
So I wonder, so how do you think about like manage their expectations? Just because if you explain to like friends and family and then say, hey, the money will be gone for 10 years, or maybe you'll never make it back, yada yada yada, like will people actually turn on you if shit goes south?
So I think that's very important to basically be not to oversell, right? I'm trying
Mhm.
to be very clear, guys. I cannot promise anything. This is a risky investment. I'm always being very clear. I have a track record. 50% IRR, I'm not telling you that I will achieve 50% IRR with your money. We
Mhm.
hope to achieve 20, 25%, but there is a mathematical possibility that you might lose your money. And I'm very, very clear with everybody. So only invest money that you are uh, that
Okay to
will
lose.
not bankrupt you if you lose, right?
Mhm.
So, but also that you are okay to not see for the next 8 to 12 years. It's very, very important to make it super clear, right? But at the same time, you know, venture is such an interesting beast. Building a venture firm, it's a it's an industry that's not forgiven to bad results, unlike
Mhm.
startup building, right? So we know, of course, the founders are often second, third time founders because the first or second startup didn't work out, and they went bankrupt or they dissolved and they lost their investors' money. And then they're building another startup, and I support them in that, and I invest all the time in the second, third time founders when the previous ventures didn't work out. With VCs, the time to know the results of the first fund is so long that and the expectations, because the fund is obviously less volatile than a company, you're not expecting the fund to return you 100x, but also you're definitely not expecting the fund to lose you 1x. So to lose your money. So basically, if the fund ends up losing the LP's money, it's very, very difficult for this GP to raise money after that, right? So, or do something else in the VC space. So that is a very interesting problem that basically makes it uh, even more important for people who are starting their first fund to know what they're doing, right? So, and to basically avoid the mistakes. So, but returning back to the question, do I have the any LPs with unreasonable expectations? And I don't think I do. I think that everybody who invested understands that the money is gone for a while, right? So, and nobody is trying to say like, hey man, 3 years in, where's my money, right? So it's like
Mhm.
it's a long-term investment, and thankfully I don't think anybody invested over their head too much of their money, right? So, and if they do, then I'll help them to basically deal with secondary market or something. But my I'm grateful that my LPs understand tech, understand
Mhm.
venture, and understand the like a slow build up to the high outcome.
Mhm. I wonder, so since you're like chatting with, we talk about like three type of LPs, right? Like there is a institutional stuff or family office or individual. So I guess like for the, let's say the seven meeting, ones, like how do you kind of structure the different meetings? So I've heard um like some friends or like the new emerging LPs, their suggestions to like try to land the next meeting be interesting, but I kind of feel like that's not what professional people would want. So like after, let's say, the second one, maybe they're asking for your deal memo or whatever, like how are typically, like, let's call it like a LP conversation kind of go for the next like two to like four conversation instead of
So
like the first one.
So the interesting, of course, as I mentioned already, raising for a fund is very different than raising for a company. And the biggest
Mhm.
difference is the timelines are different. When
Right.
you raise for a company and you talk to a investor, it's often like you only have a month or two to raise, maybe three, and then you want to talk with an investor every week or 2 weeks until they
Mhm.
make a decision.
Mhm.
LPs are often not really willing to talk with you every week, right? They need
Mhm.
to be it professional or unprofessional, both, right?
Mhm.
So what I see is that biggest difference is that the cadence of conversations is uh, much further apart, right? So, and if you have a first call, you need to be so interested in this first call that they will not forget about you in a month or two, because they will probably not talk to you for the next few months, right? So that's, I think, I learned a lot, right? And then the way I think about it is the first call is always just an introduction, right? So, and it's important to share about the story, the background, like what makes you or me in this
Mhm.
case the right person to invest the money, and then focus a lot on the strategy and differentiation. And if you don't end up impressing LP by like differentiation strategy or a track record, then they will tell you, yeah, of course, let's talk later, and you will never be able to talk with them later. But what is important is for a second one, it's always about updates, right? It's almost always about like what happened since we first spoke, right? So, and this is also how it's very difficult in the first call to actually get the second call on the calendar. So typically it's like, let's talk again. And then it's an email from me in a month or 2 months saying, hey, we talked about it. Here are the important updates since then, right? Maybe some of our companies got a markup. Like I just posted that last month was amazing for us. 5 of our companies got markups in just 1 month. And
Congrats.
that helps. Yeah, thank you. That helps. I can say like, hey guys, like compared to last month, we have 5 more markups in the portfolio, and they're like 2x, 2.5x, right? So, and if there is a fundraising period, just being very clear about deadlines and the timelines, and then offering to meet. Another thing that often happens is the first call is on Zoom, and I'm trying to get the one of either second or third one in person, because I find that in-person meetings, if you never met before, are very significant help to convert somebody to be an LP.
How do you think about writing your deal memo as an angel to as like a fund manager? Just because I think like LPs may ask you for your data room or just like deal memos, but like I said, angel, your deal memo is kind of like, okay, it's not, I wouldn't say it's like a vibe check, but it's more of like, okay, do I think this team will be able to attract more money in the full on runs, or can they recruit technical talent? Can they close a customer? But generally, it's less of like, okay, how much ownership you're trying to target at the beginning, and then the second run, and yada yada yada, right? Like, and then the return profile. Let's say like, if you dilute 50% by the time they IPO, portfolio construction, you probably don't have to think about that. How do you kind of translate that into your deal memo if LP asks for one?
So we create memos for all our investments, and of course, we create memos for companies we don't end up investing as well. So, and we typically focus on the company and on whether we are excited to invest or not, rather than the fund-specific minutia like amount or ownership or things like that, or portfolio construction, because that's not part of the memo for us. The memo for us is about multiple things. First of all, is this the right team? So we talk a lot about the team. Then we talk a lot about the vision and the market, right? These are things that together. Is the market big enough to support really high outcome? And is the vision that company and the team professes, is it something that we believe in? And is it something that is big enough, right? And then we talk a lot about the factual things, like what happened, how fast they're moving, what's the revenue, things like cohort analysis, customer references, things like that, to basically understand whether what already happened can give us a lot confidence that this company will grow a lot. It's like basically a summary of all our discussions with the company and the other people around, like be it references with customers or previous investors and so on. And often when we follow the company for a while, we often invest after we knew the company for several months or even half a year or even more. The memo would be like multiple parts, right? So what we knew back in, let's say, February, then what we knew in July, how does it compare, what was the growth in between. So what's important is that in the memo, we try to analyze not only whether it's a good business, but whether this company has an outlier potential, right? So it's because we as a venture fund, we want to invest only in companies that have a potential to go to 50x or more for us, right? So this is often what we talk about in the memo, is like whether can this company be a $1 billion company or a $5 billion company in the future.
How do you reflect that in, I guess like in like a memo format? So like obviously there is, and you mentioned about the team, the market, and do you I guess like how long do you guys wrote it, and then like do you guys have some sort of like a form that the founder will formulate themselves. And I'm sure like the founder also sent a bunch of updates. Like, how do you kind of like track all of those since you have like a really big portfolio?
Yeah, so first of all, of course, we track updates for our portfolio, but we also track updates for companies in our pipeline, right? So, and
Mhm.
that's interesting too, because typically if we meet the company but we don't invest, they often add us on their investor updates or newsletters, and I recommend everybody to do that, right? So
Mhm.
not everybody does it, but yeah.
Mhm.
So we receive newsletters from hundreds and hundreds of companies. But for our own portfolio, we have a specific process. We have about 50 companies right now, close to that amount
Right. Mm.
in our portfolio, and we ask founders to send updates every month, but we are also okay if they send them every 3 months, and we think that every 3 months is the minimum acceptable cadence. And we have a separate mailbox. We are making sure that everybody on our team, all people receive these updates, and we actually have a separate table in our portfolio air table, and we have a separate channel in our Slack where specifically every time there is a portfolio update comes from our portfolio company, which typically being 50 company, like 40 something companies sending them once every couple months, means that we get about 20 a month, right? So almost every workday we get one portfolio update, right? And sometimes like first week of January we got like 10, right? So it's
Mhm.
like it's often they're often clustered. So we discuss them asynchronously. We record the progress. Like for example, we know that for every portfolio company, we know over time how the revenue changed, right? So we can easily track is like are they are like 2x year over year, 3x year over year, even if the founder doesn't track
Mhm.
it. And we are always discussing the team that asks. So not every portfolio company does it, but those that include the ask in their portfolio updates, we always discuss it as a team. And we have regular portfolio update meetings with the team where we basically everybody on our team for an hour every several weeks we discuss a list of portfolio companies as like, okay, how can we help this company, how can we help that company, is there a surprise, like for example one portfolio company says that one of the co-founders is leaving, one of the companies says that they're pivoting a lot, is like how does it affect our story. And one thing that we are also always thinking about uh, is this company something that is their update makes us to think about potential investing more, because we are very uh, active follow-on investor, but we only invest follow-ons in a small percentage of our portfolio companies, right? So if their update is very positive, then we could switch this company into basically investment discussion.
Mm. I wonder, so you mentioned about like there is a separate like table channel in like Slack, right? So is this like just auto generated? So for example, I send you a newsletter of like my company does so well, we're hiring for another engineer, we're growing like this, and then like it just kind of like translate into like a filter on Slack that's kind of like
I
connectivity flow
Yeah,
sheet or
we are working on automating that. My thinking is that the tools are not that strong right now to be
right.
reliable on that.
Mhm.
Uh, we are using we are manually updating some data, and we are working on
Mhm.
automations. And I think that in fairly uh, you know near future it will be automated. The problem is of course
Mhm.
that every company sends them in a completely different format, right? So
Right.
and being a founder friendly fund, we don't want to force founders to just okay, you have to send your update in this specific format, right?
Mhm.
So and yeah, right now it's something doable. I think if we get we that's where it differentiates probably us from I don't know accelerators, right, that have
Mhm.
hundreds and hundreds of companies in the portfolio. If we will get to the many hundreds of companies in the portfolio, maybe we will have to do it in much more automated and mass way. Right now
Mhm.
I personally read every single update with my own eyes, right? So and from portfolio companies and other people on our team as well. So I think that's it what helps us to be connected to them.
Mm. I guess I think I totally agree with you on like I feel like right now maybe because of like all the reports maybe like multimodal, so sometimes it's a picture or different people have different formatting
Yeah.
way. So like, okay, I want to talk about uh you know another thing I thought your fund is interesting is like I feel like you're keeping it more towards like generalist approach, though you invest in primarily in like immigrant founder built companies. But as you know, like most companies are immigrant built. So how do you, not most of them, but like a lot of them.
A lot, a
Um
lot.
yeah, I love them. So I wonder, how do you think about having a just like no specific focus slash like a generalist approach? And then also I feel like it sounds like you guys are not doing you guys are doing more flat instead of like a concentrated approach. um how do you think about, like, how do you convey that into to LPs? Because I feel like a lot of the LP would question and say, we want you to have a concentrated approach because we're investing in 10 different funds, and so we want to make sure that, like, we own significant amount of the company that will be a breakout success. I guess, like, how do you answer the question when like LP asks you to be more concentrated?
So there are so many aspects to this question. First of all, right? So every LP is different,
Mhm,
and there are LPs that prefer one strategy, there
mhm,
are LPs that prefer other strategy. What's important for us is to just be the best possible fund and not try to just follow the cookie cutter rules, right?
mhm,
And this is why I personally don't think we are a generalist fund, and I also don't think we are a not concentrated fund. But I also, we are not neatly falling into one bucket or another,
mhm,
and I don't want us to, right? So I want to communicate with LPs about, very clear how we approach it. And here's what is important, right? So we invest in immigrant founders in the US, so which already geographically clarifies that we are a US fund focused on US companies and US customers.
mhm,
But we are also investing in software and AI, and we do not invest in a lot of other things, right? So
mhm,
like biotech or materials or pure e-commerce, marketing-driven things, things like that. We have multiple areas of focus, which is also a lot of other funds have, right? So we, for example, we focus a lot on marketplaces, and we focus a
mhm,
lot on vertical AI for legacy industries. Uh, we do cover a lot of industries, right? So, and this focus allows us to clarify to our LPs is like, what do we want to invest in? Typically, it's a
mhm,
strong software team, technical team. They have to have either like being AI first, and AI should be like the bread and butter of the company, or at least use AI in a very, very smart way and be reliant on it, right? So, uh, and on one hand, on the other hand, being broader than some super niche funds. Of course, we are not a super niche fund that only does, healthcare,
mhm,
B2B, or only does like, property tech, or only does,
mhm, mhm,
things like the government, things like that, right? So this allows us to be much wider in our deal flow, right? And this is why
mhm,
we are looking at several hundred companies a month,
mhm,
right? So because and this is why it's really, really helpful for us to have relationship with 500 other VCs and look at
mhm,
all the deals that they're doing, to basically see the best ones, the best that
mhm,
are fitting us. And a lot of companies fit our thesis, which is great because it allows us to pick really, really, really the most promising, the most amazing founders. From LP perspective, on that side, I see that there are some LPs that only want like one sector fund, right? So they
mhm,
want sector specialists, which we are not calling ourselves sector specialists, right?
mhm,
And this is fine. But uh, you know, in my time at Geek Ventures for the last almost 4 years, I've
mhm,
probably met like one or two LPs that said like, okay, guys, that Geek Ventures is not a fit because they want sector specialists. And I spoke with hundreds and hundreds of other LPs that say, oh, this, what you're doing is interesting. They like our immigrant focus, they like our US focus, they like our AI and software focus. And on the concentration piece, this is very interesting because, of course, I met funds on both sides of the
mhm,
spectrum. I know really good friends of mine that are doing 12 companies per fund,
mhm,
3, 4 companies a year. They take board seats and almost all of them. They take like 10% ownership
mhm,
and so on. And I know the funds that do 100 companies per fund, they never follow on. They do like 1% ownership. They don't really, re-engage with the founders
mhm,
because they have way too many companies. And LPs, they find both of this, of course, find the LPs because, but most LPs don't like this way of extremes. What we found is a really, really smart place in the middle where we say that we invest in about one company a month, in about 10 to 12 a year, which translates in about 30 to 40 companies in a fund. And we will follow on, we have significant follow on reserves to increase ownership in about 8 to 10 of them. So by the end of the fund, we have about half of the fund in 8 to 10 companies and another half of the fund in the other 20, 30 companies, which basically gives us enough shots on goal, right? So which every deal, like every month, we have a shot on the potential unicorn, potential IPO. And you know that when you have 12 companies in the fund, there is still a chance that none of them become a winner, and then your fund is screwed. But if we see that the companies that are showing really good progress, then we have an opportunity inside, while the outsiders don't know about it, to increase our ownership and then basically act as a concentrated fund in those 8 to 10 best names. So
I wonder, I really like that, but I think the other thing is like, how do you evaluate the ones that you would um invest for the follow-on round? Just because I think, how do you like kind of articulate the evaluation process? Just because everybody knows it's like team, it's like the growth trajectory, yada yada yada. But like, I think, how do you translate that into LPs? Because they probably want to see something more formulated instead of just like a vibe check, basically.
yeah, of course. So here's an interesting thing, right? So the early stage, it's it's a very important balance and a very difficult balance between a completely vibe check thing, which is sometimes like an angel approach or pre-seed approach, versus a completely formulaic, which typically works at private equity or growth rounds, right? And um, we talk about with our LPs, and some. I remember one conversation with our LP who is LP in 6 different funds, who said that our LP has the best our fund has the best communication setup with our LPs, and they really know what's going on inside, and they know why. But we basically talk with LPs all the time when we think we found the winner inside our portfolio, and we are doubling or tripling down on it. And the way it's always case by case, extremely always case by case. Most important things is we have limits on what percentage of the fund we can deploy into one company. Typically, it's no more than 7%. So if we over deploy in the company, then no matter how good it is, we will not continue investing from the fund in it. But we also need to see that we have built a significantly more stronger relationship with the company than at the time of our first investment, right? So we have better understanding of the company, more knowledge of them inside. So we need to rely less on external reference checks because we know the company and the founders for at least several months. So we typically do it only at least after 6 months, but sometimes after 12 months or more. So we have built this understanding of the founder, and we see that we are able to invest again at better risk reward ratio, right? So the company is improving, and meaning by improving, it basically has better metrics, or maybe they launched a product that they didn't have before and it's amazing. So the risk goes significantly down, but the valuation increase is investor friendly, right? So for example, there was one company where in 6 months their revenue went 4x, but we were negotiating our entry at 2x valuation increase, right? So which basically means that they didn't only increase the base revenue 4x, they actually could have demanded higher multiple on revenue because their growth rate increased. But we managed to negotiate lower multiple on revenue than in our first investment. So basically, it became a really smart risk-reward approach with the second. So our most important thing that we communicate is that our follow-ons are proactive, and we negotiate them, as opposed to being just, participating in the next round that somebody else is leading and somebody else is negotiating.
Totally. Okay. So, also like one of the audience, hi Fatima. So, yeah, like we can. So basically, she was asking about like fund management recommendations. So she was talking about like she have clients use Carta, but I don't know. I feel like that's I mean, she basically asked about the fund management platform.
So we are using Decile Partners. So it's from the same company that runs VC Lab, and
Mhm.
they are fairly new. I mean, they just started about 4 years ago, as opposed to Carta, that's a little older. But they have taken, I think, VC world by storm. I think
Mhm.
their administration services um, are impressive, and they are doing it in a much more
Mhm.
precise and you know white glove manner. And we like them so much that we ended up investing in their company as well. So now we're
Mhm.
also investors in this app.
I will need to like recommend you one of my small angel investment portfolio. They're amazing company. But we'll get to that later. Okay, so that's about your investment. So you have invested in Instacart, chain analysis. Why don't we talk about what are like I guess like how do you like find your best deals, and then how do you kind of like um create some sort of like funnel that's like kind of repeatable, just because I feel like I think you and I had a conversation before, and it seems like everybody will source from everywhere. You never really know where your best deals are coming from, but I'm sure like a lot of the investors will ask what's the repeatability, right? And like how do you think about that for your own pipeline building?
Yeah, so I think that this is a very good question. The most important thing that I'm telling everybody, that every single winner is a very custom, very different company, right? And very different sourcing, because
Mhm.
uh, it's not like it's not a cookie cutter, right? Unlike accelerator, it's not
Mhm.
about just here's the form, you sign up, and we have a process of looking at every company. It's
Mhm.
always about searching and searching and searching. And for us, what works absolutely the best is talking with other investors or founders. And
Mhm.
it's a very interesting thing that we have found in the past really good companies through cold inbound. By the way, you can submit your company at our website. I think Sarah is posted in the comments under this the link to the form, and we will definitely look at these companies. What I found is that it's extremely important for us to keep relationship with a lot of other investors and founders,
Mhm.
and just hear from them if they know of any exciting company raising money right now, right? So,
Mhm.
or even not raising money right now. And this is how we get a couple, one to several recommendations per day, which basically results in about 100 per month. From the people we know, right? So I just was on a call with another VC yesterday, and they were so excited to tell me about one or two companies they just found recently that they're investing in,
Mhm.
right? So it's like, okay, cool. And if we hear from other VCs or angel
Mhm.
investors or just founders about this, like companies that are starting, this is creates us a really strong
Mhm.
funnel. So we typically
Mhm.
hear about this 100 companies a month that are somebody
Mhm.
super excited about, and we talk to probably half of them, and we end up
Mhm.
investing in one, right? So
Mhm. So I think you briefly mentioned about like chain analysis on another podcast, but maybe we could talk about Instacart. I
yeah.
feel like how do you meet these like iconic companies?
So Instacart, yeah, of course, when I invest early stage, they're not iconic in any way, right? So they're just a company that somebody just started very recently, and that was back in I think 2012. I still lived in Zurich, and I was hanging out. So I was always looking to increase my network, right, and
Mhm.
looking for great people to meet, and that's, I think, by the way, is absolutely key for anybody who wants to be VC.
Mhm.
Make sure you're always improving your network. So back then, I was an engineer in Google in the Zurich office, but I already had some friends in the founder community, and I was just introduced to a new founder recently. We were having beers and talking about startups and everything, and she told me about. Then she heard that I just started investing. I started angel investing like before that. I invested in 2-3 companies by that time, and that she heard that her friends are working with angel investors in California. That was the company Funders Club, right? So, and I spoke with them, and they told me about Instacart. That was a very interesting thing because it was, I think Instacart was in YC batch in summer, and Instacart just started working in San Francisco. It was back then. The YC companies actually had a product by the demo day and the revenue, which is less common now. But back then, they already had been delivering to several neighborhoods of San Francisco. And for me, it was such an obvious thing. So by that time, Uber already existed. By that time, Uber was already on serious something, like I don't know, A or B, and you could use it in multiple cities. And Instacart was probably the first company, Uber for something, Uber for X. There were so many years of companies doing Uber for X. Instacart was Uber, but for groceries. And it made absolutely sense, right? So it was a gig economy. That the term probably didn't exist back then, but it was like obvious that, people want to use their phones to order stuff, right? To order real life stuff, right? So, and Instacart was one of the first companies that actually had proven that it works in 1 or 2 neighborhoods. And it was obvious to me that food is a huge market. Like it's tens of billions or hundreds of billions of market. And yeah, I invested.
How do you choose how do you pick or choose a founder in certain, this is like also from the audience. I want to kind of pivot that question a little bit on like competitor analysis, just because as you mentioned about when you were talking about Uber for X, I feel like there's a lot of like Instacart equivalents out there at the very beginning. So I know that my friends backed GoPuff before, and like I wonder, how do you think about like the differentiation, since some of them were already there for years or already there, but like also I wouldn't say dominant, but like also having some sort of market share, that which one can actually last?
So GoPuff and was started much later, and it was more about like fast delivery space. Very, I think that they of course competed with Instacart, but they're also very different, right? So, and my thinking in general is that competition is important to understand, and if the founder doesn't understand the competition, they are not going to win. But also, it's never just first company will win, and that's the only thing, right? For a VC, especially early stage investor, it's I think it's totally reasonable to invest in a second or third or fourth company, and they will make a lot of money still, right? So, and it's very different in public market, I think, right? So, and I think the great example is Uber and Lyft. Lyft is, as a public stock investment right now, is not doing so well, right? So, and they have difficulties competing with Uber. So, but for anybody who invested in Lyft early rounds and then exited at IPO, they all made huge amount of money, right? Because after all, Lyft got to IPO tens of billions of dollars. Another example from my own portfolio is PandaDoc. PandaDoc started as a tool for seller contracts negotiation, and then added Signature, and then Signature became their main electronic signature main tool. And of course, there was a point where they were obviously not the first one competing with DocuSign or HelloSign or other companies like that. But the thing is that by now they're still they're making 100 million ARR, which is less than DocuSign, but it's $1 billion company. And I invested in the very first round. So when I exited a little bit on the previous round, I made a very successful exit, right? So from that perspective, what is important is the market, not only who is going to completely win the market. What I think is like, is the market big enough to support multiple winners? And of course, we want to be invested in the company that will win, of course, and this is what we expect of our founders is play to the win for the win, but it
Mhm.
also doesn't mean that we will pass on the opportunity if you think it's there are competitors, right? So for example, when Lyft was raising money, I think Andreessen Horowitz invested in Lyft when Uber was already bigger, right? So and uh, they still made money. So my thinking there is, of course, if you invest in a company that's competing with already existing company. By the way, Instacart didn't really have competitors when I invested, but if anybody invested in GoPuff, they knew that Instacart already existed, right? So they still were thinking that, okay, is the founder strong enough to take a significant market share, right? So and are they approaching the market differently? One thing that I like is that if there is an obvious like gorilla in the room, and a lot of companies we invest in, they compete with something big, like they might compete with Salesforce, for example, right? So or something else. The question is, are you doing something that's significantly different, that you will have some customers that just don't like the way the bigger competitor is doing things, and they will be convinced to join you because of your way. Similar, like for example, how Lyft was always just like nicer, like more comfortable, warmer version than Lyft, like with pink mustache and so on. And for a long time, it was also cheaper version. I don't think it held for too long, but it was also, so they found the niche where the people wanted them over Uber. But similarly, Instacart always found the niche to compete with GoPuff. But also GoPuff, with like 15-minute delivery, found the niche that didn't want to use Instacart, right? So
Yeah. I wonder, another question is like, I feel like another thing is about like YC. I feel like many angel investors, especially outside of Silicon Valley, they would just literally go scrape the YC list, talk to everybody, invest in like 10% of like the people they chat with. How do you think about that approach? And how do you even filter out companies from YC lists? Since like, Instacart was a YC company, there's many unicorns coming out of there. But I think the big challenge is like picking which one, right? Unless you have like a spray and pray portfolio there, like I think it's kind of hard to like filter out the one that will make it.
yes. And for us, YC is not a focus, but
Right.
we also don't ignore it completely. I think we invested in 2 post-YC companies last year,
Mhm,
and we prefer when our companies that we invest first go to YC
mhm,
after. But
mhm,
the way we approach it is that, first of all, I respect YC a lot. I think it's the best system out there, the best accelerator, and I think
mhm,
that LPs in YC funds are, making a lot of money. And in general, from YC perspective, they're doing a really good job of investing early and also helping companies. From an investor, or in terms of analyzing YC lists of the companies,
mhm,
I find that you need to really have a strategy when you go into one things,
mhm,
because every batch, there used to be 2 batches per year, now they want to do 3 or 4 batches per year, has like 150 to 200 companies. And of course, just reading about them is so not informative, right? So it's like, you need to talk to them, and then you cannot realistically talk to 100 companies and not be like completely
mhm,
exhausted and spend like 2-3 months on that. So the way we think about it is, we still try to work with a lot of connections and work with other funds, and we try to learn about YC companies before demo day to avoid the situation when the best companies were already finished, closed their rounds, and only the rest are still raising. And we are trying to position ourselves as the fund that they want to work with, right? So,
mhm,
and it often really, really helps to be in the case where YC company becomes hot and they raise, they get a lot of interest, and they need to pick between funds. One thing that actually happens a lot with YC companies in the last couple of years, that they are managing to balance supply demand by having a really high valuation, right? So
mhm,
when there is like a pre-seed company with no revenue and 2 founders and no team and 25 million cap, there is a reason why they take 2-3 months of raising $2 million, because there are very few VCs or angels that want to put a lot of money in this. Right?
I have a question on the valuation cap. So like obviously it's a cap, but like do people just typically go for and that's gonna be the finalized valuation or no?
Yeah. So in most cases, the valuation cap is the valuation, right? So it has some investor protection that would play if the company actually ends up raising the price round below the cap, but that's rare, right? So in most cases, the way it goes is the company raises, let's say, 2 million safe on 25 million cap, then it takes a couple years to basically try to get to some sort of PMF, and they might end up raising a flat round at another safe at 25, or sometimes they raise at lower safe, which doesn't change anything for the previous investors, so which is, I think, the most kind of annoying place to be in, that they already raised 2 at 25 and then they raise another 1 on 15 or 2 on 15, but the previous cap still stays. And then let's say 2 years later, which, by the way, sometimes it happens when we see a post-YC company 2 years after their demo day raising at the same cap as in YC, but already with a product, maybe after a pivot and so on. And what happens that sometimes 2 years later, they didn't find the PMF, they don't have sales, they run out of money, they don't have a story to raise with, and they close. At that time, it doesn't matter what your cap was. Or they found some PMF, they made like $1 million ARR, and they raise a priced round, and that priced round is typically a little bit above 25. It'll be like at 30, at 40. But in some cases, and this is basically like 5% best companies, it will be at 50 or at 100, right? So, and that 25 becomes a really, really last, really real valuation. Yeah.
I have a question there. So like, okay, so there's like two parts of the questions. One part is like, I have founder that ask me if they should raise, like for example, let's say they raise like $1 million pre-seed, but they are raising the next round. They were thinking about they just straight raising a Series A instead because they want to dilute less, they want to raise more money. They have $1 million, roughly $1 million in like ARR. So like, what's your advice for them? Should they just skip seed or like they just like, still raise a seed? I don't really know why these terms even matter. But I guess like it's just like if they fall into the valuation range, right?
So here's the way I think about it. The terms don't really matter. I see seed rounds, 10 million round at 80 million valuation. I see Series A round, 3 million at 20. It happens. The terms don't matter. What matters is, do you want to raise or not? And what is the valuation that you're comfortable with or not? And here's an important, extremely important thing that all the founders need to understand, that if you want higher valuation, lower dilution, it will take longer to raise, or you will not be able to raise at all. And because supply demand works is very simple. The lower valuation, more demand from investors. The higher the valuation, less demand from investors. This is why, as I mentioned already, pre-seed companies post-YC at 25 post take long time to raise their like $2 million, while if they didn't go through YC, it's like impossible. And for your friend who already raised $1 million of pre-seed and now they're thinking skip the round or not, the biggest question there is, do they have enough money right now to not raise now? And my advice to all founders is like, never go below 9 or 10 months of runway, on one hand. On the other hand, if you know how to invest more money, raise money now. Because here's the thing. We as VCs, especially at seed or Series A or Series B, we want to invest in companies where it's very clear, fast growth to the results. And by results, I mean like unicorn status, IPO, like 100 million ARR, billion ARR. And if you are saving money by not hiring people or by not spending on sales or by not spending on marketing because you want to not raise now, because you want to not dilute yourself, you will just move slower. For example, right, I have a very specific example of a founder who I know for a while, who has achieved multi-million ARR already, and then went out to the market to raise. And I would advise that founder, try to raise at 30 million valuation, try to raise a lot, like 5 or 6, right? So, and he's like, no, that would be too much. Let me raise 500,000 at 30 and then go try to raise 10 at 50. And I'm like, nobody will give you 10 at 50. And he's like, no, let me try. And then he raises 500,000 at 30 and then goes to the market and tries to raise 10 at 50. And it takes him a year and a half, and he still doesn't raise 10 at 50. But in the meantime, he has to operate with very little cash in the bank account. He has to have layoffs. He has to have so low salaries. He has to have no headcount growth, no sales growth. So by the time a year passes, his year-over-year growth is 30%. And I'm like, now your year-over-year growth is 30%, and you have 2 million ARR. You will not get even 20 million valuation anymore, right? So it's like, if you want to get, and he wants to get 50 or 60, it's like, if you want to get, it's like, raise money at valuation that you can, that people want to give you, and put this money into growth. Here's my advice is like, if you are building a future IPO company, raise money now, raise enough, invest it into growth, and then a year from now, raise again. And here's the important thing. Having 5% of a $5 billion company is way better than having 90% of a $10 million company.
For sure. I love that. So I want to maybe keep the question shorter because I don't want to like waste too much of your time. I have another question on this end, right? So like the valuation you mentioned were I feel like in the Silicon Valley standard. So like I've seen, I know on Carta it says like I guess 6 million was like the median valuation last year for seed. But as for like Silicon Valley, the hot AI company that does like AI agent for coding, like everybody raised more, right? So like, and then the founders, when they're seeing their friends, raising like $100 million on seed round, it's crazy, right? So like, and then so they decided to put the valuation cap higher, or maybe they raised in 2022, the valuation was higher, yada yada yada. But how do you advise people on when the founder come to you to ask, like, should they, I guess, like, how do you even, like, as an angel investor, what's your valuation cutoff line? So let's say they put valuation cap as like a 30 or 60 million. How do you kind of negotiate or just like not look at it at all?
So from advice perspective, it's extremely important to understand why other investors give high valuations to a specific company. And there are a lot of companies that build AI agents for coding, or a lot of companies but not all of them are able to raise 100 million seed. There are, and the biggest difference that makes these huge rounds is typically a very significant pedigree of the founder, right? So it's not just the vision or the idea, right? So, and if you just take the same idea somebody else, you will not be able to raise 100 million round. It's almost always these rounds are from pedigree of the founder. They have strong connections. They have been respected by the industry, right? So, like for example, there is ex CTO of Stripe that I actually worked with him at Google. Extremely respected guy. Goes out of Stripe and raises for dev agents. I think he raised 100 million in the first round, right? So it's somebody who's just coming out of university, or even was just like an engineer at big tech, starting a company, will not be able to get anywhere close, even 10 million for kind of the same vision, even, right? It's very, very important to understand that. And then it's important to basically for founders to see that it's all about supply demand. My approach, and here's my typical valuation advice. So if it's a pre-seed, and by pre-seed I mean there are several even parts of pre-seed.
there is like pre-product, pre-seed. There is nothing done yet. There's obviously no customers, obviously no revenue. There's even no product to touch, right? So then the valuation could be $2-3 million if the founders are not extremely, well known, and it's their first company they didn't raise before. Maybe 4 million, depending on the vision and the strength of their background as non-founders. But at the same stage, if the founders raised before, and they probably raised like 10, 20, $50 million before, that could be a $10 million company, even pre-product, pre-revenue. Then there is this pre-seed when there is a product, but very little revenue. We still call it pre-seed. The pre-seed when there is a product, but either no revenue or like 10,000 a year, like 1,000 a month revenue, that's typically $5 to $10 million range. Again, the founders who are like first-time founders or their previous company, they didn't really raise any money, it's 5 million. If the founders have already raised some money, maybe made an exit, it's probably $10 million valuation, right? And this is for us, it's like all of that, what I described is how we invest, right? So, and we also, like, for example, we spoke with a founder who didn't have a lot of background, but didn't have a product and raised at 10. We say, okay, we'll come back to you at 10 when you have a product, right? So it's like, and then we can talk to them. But there is another company where it's no product, but really strong experience of the founders. So 10, okay, we can do that. And then there is seed. Seed for us typically means that there is revenue, at least 300K a year, better 500K or 600K a year, right? So, and of course there is product. Of course there is, some proof that customers love it. That's where we typically see valuations between 10 and 30, right? So, and 10, and that's has some correlation with revenue. If it's like 300K a year, 400, 500K a year, that's probably 10, 12. If it's between 500K and a million, it's probably 12 to 25, right? If it's like, of course, there is a markup if it's very pure AI story, right? So if it's generative AI and that's all they do, then it's probably 20 to 30 if they have revenue. Right? So
Totally. Okay. So I want to be mindful of the time. Let's wrap up with like a 1 minute fire round for you. What's your favorite book?
My favorite book, Game of Thrones by George R. R. Martin.
Who made the biggest impact in your career?
The biggest impact in my career, I think probably it was Bhaskar Mehta, who used to be my manager at Google and is now a senior director at Meta.
Who would you invite to your dinner party?
Who would invite me to dinner party? Well, a lot of people, like typically friends who like somebody who will be very talkative, I guess, and who wants to discuss things.
Me. But anyway, where can we find you outside of work?
On the ski resorts, at board game meetups, at Game of Thrones conventions.
Game of Thrones conventions. What are you gonna dress up for?
Yeah, I dressed up last time as Jon. It's a mix between Jon Snow and Stannis, but yeah, it's just a fun thing for me. I also, what else I like? Yeah, I think these are the core things. I like book reading, but that's typically mostly at home in my armchair.
Love that. Okay, so yeah, I guess like I'm just expecting every AGM your LPs will just receive a new board game. I would assume that's the merch of researchers. But anyway, Ihar, thank you so much for coming on the show today. It was such a oh my god, my loyal listeners from Twitter are joining. Hi, Scamdy. Anyway, thank you so much, Ihar, for joining our show. It was such a fun conversation.
Thank you, Grace. And yeah, looking forward to seeing the recording as well. Thank you, Grace.
Okay. Let me quickly end stream.